if banks create money, why do they ever get into trouble? And of course, they do get into trouble. In 2008, needed, well, initially £6 billion, and it turned out it was £10 billion in new capital. If they create money, well, they can just create it themselves. Well, yes. And at Barclays, unlike RBS and Lloyd's, they were paying attention. So they did create the needed 10 billion in the end themselves. You need a strawman that you lend the money to when you create it out of nothing. And that needs to be sufficiently large so that 10 billion don't really stick out and cause auditors to raise too many eyebrows. So they found in the Gulf region one of their customers, Qatar, who they offered new preference shares to buy to raise capital. Qatar said, well, late 2008, it's not a good time for us to, we're fully invested to now sell like US stocks and buy your preference shares. Would be locking in those losses. No problem, we'll lend you the money. And so the Barclays loan created this new asset, the loan to Qatar, which then was, of course, immediately switched from the accounts payable liability into a deposit. And then you issue your new equity, and you have a simple liability swap of the equity being paid for with the deposit, and you have created your own capital. Now, that's what Barclays did, and also Credit Suisse, by the way. Credit Suisse had the advantage that the regulators are slightly more, I don't know, shall we say, continental, straightforward about these sort of things. And because these banks will always tell the regulators, whether officially or not, but they will always tell them. And the Swiss regulator said, okay, fine. We don't want to use public money to bail you out. So, okay. And that was a done deal. In the Anglo-Saxon countries, they love this idea because of the role of secret services and covert operations and the deep state in general. They love the concept of plausible deniability. So when the Bank of England said yes, it meant yes, but if it comes up, we've never heard about this and you'll be in trouble, right? And this is exactly what happened, but it's quite telling because when the Serious Fraud Office did look into this, it's like, here's the elephant, because this, according to the Companies Act 2006, is illegal, very clearly, because it states that you cannot lend the money for a new shareholder to buy your shares. And that's particularly relevant for banks because it's complete bootstrapping, right?